Hello, hello. Good afternoon, good morning. You'll have to bear with me. Looks new neighbor and looks like even louder piano. So you'll get some background music while we go through, whatever we have to discuss. So hope you guys had a great long weekend. It was a little weird, at least from the market perspective, because generally, I would expect market to be closed on Monday, but it was like a weird way in which it was half closed on Monday. Um, and I think the market closed on 1 p.m. Eastern time on Monday. So Saturday off, Sunday off, Monday half closed, Tuesday off. A little weird. I don't know why they had to open it up for 3-4 hours just for Tuesday, just for Monday, because you suddenly are caught, in surprise that, hey, I thought it's a long weekend, but then the markets are open. So hope you're all refreshed. Anything exciting to share or from a long weekend? From a trading perspective, from market perspective, it was a short week, of course, because of the holidays. But anything new you guys did over this weekend? I'm gonna share. I actually we traveled, and I also used the time to finish a book. I'm gonna share something from that book today, but I think in subsequent sessions, probably a few more things I'm gonna bring about from what I learned over this long weekend. All right. So today, I think the main topic will be adjustment of option trades. So we didn't meet last week, right? So we met a week before. We talked about what's the best way or what's the best setup for opening an option trade, right? We went through the whole criteria of 7-8 criteria on what we should look at before we open an option trade, right? Including implied volatility, your portfolio concentration, and which strike price to pick up, how you pick up the deltas, and everything else. So today, want to move a step forward, saying, hey, now we are put on a trade, and then what if that trade is going against you? What should we do? Should we do anything? Should we just sit on our hands, or on our back ends, or can we do something about it? So that's where the option trades adjustments come in. So we're going to talk about that today. Okay, I see some new names in here, so let me make sure. I just want to make sure that this session is useful for everyone, and so I do see a few names. I see Ishwari, Krishna. I don't think I've seen these names before. Shanu. Hello, welcome you all. I believe this is your first time joining in, or did I miss you guys? Sorry? No, is this the first?
Hi, yes, this is Shanu here. Yes, this is the first time I'm joining your meeting. I'm happy to be here.
No, welcome. So I just want to know, what's your expectation, or what do you plan to gain out of this?
Actually, I am interested in option trading and general retail investing. So just to get more ideas, or there is no right or wrong answers. What your inputs would be versus generally. So learning more. Improving my skills, and getting a general idea of what everybody thinks of various trades.
Yeah, cool. No, welcome you all. Yeah, so here, first of all, just to give brief background, I am not a professional trader, and most of the folks here are not professional traders. So we have either some of us are retired or they have their own day jobs, and investing or options is the side hustle for most of us, right? There are a few who joins in who are, let's say, full time into this, but most of us are investing as a side hustle for us. So from that perspective, at least I don't do anything which needs me to watch the markets, continuously. So I'm a way more conservative investor, and conservative and the options in a typical financial world, it seems to be oxymoron, because the general thinking is options are risky, but that's not the case in terms of how I trade it. I use options to de-risk my portfolio, and that's what attracted me to options is, hey, how can I still stay invested in the market while have a little time to look into the markets on day-to-day basis, right? So that's how we focus on here. You will not get the next hot stock. If you're expecting a tip on a next hot stock, that's something which I don't think we discuss here, but we do go into the fundamentals of stocks, seeing what's happening in the market. And yeah, once in a while, I also do a deep dive review into some of the stocks. Recently, we talked about Kava IPO. And yeah, we'll pick up those stocks and go deep into from an investing perspective, right? As a retail investor. All right, so that's a brief background. I've been working in tech industry for almost now close to 25 years, but have been passive investors for more than 15 years and little more active, I would say, last 8-9 years. That's when I started getting into options. All right, so today's, like I said, today we want to talk about adjustments, but as always, we'll start with something else. So my long weekend pursuit this weekend was, I finished a book called The Joys of Compounding. If you're just getting into investing, I think this is a great book from a writer who was an investment banker, switched to from investment banking to stock investing, went through some tough times. Tough times in sense, from an investment banker, this gentleman, Mr. Gautam Baid, he became a front desk, not even manager, a front desk executive, a person on a hotel, because he just wanted to move out of investment banking, spent a lot of time in understanding around stock market. So quit his job, he applied for a lot of stock investing jobs, didn't get it. So took up the minimum wage job in a hotel in San Francisco, managing the front desk in the graveyard shift. And during the daytime, all he did was read, keep on applying jobs. Eventually became a portfolio manager, wrote this book. Now he runs some $200 million his own fund. All right, so interesting stuff from this book. I do want to go through some of the stuff that I noted here, which is applicable even in today's market. Is some of the things that are in the general markets are very overrated, and some of the things that are underrated. Hopefully, there's some wisdom or there's some useful piece of information you can glean from this. Sam says, what does this mean? What are you referring to, Sam? CNBC Ant Group. Okay. Yeah, we can talk about that. Ant Group was fined close to $1 billion. It's by the Chinese authorities. In my opinion, I think it's good for the Ant Group as well as the parent holding company Alibaba, because it does brings the the Chinese regulators, litigation to a logical conclusion, right? So sometimes the initial reaction to the fines may be markets don't like it, but actually it's a close to $1 billion fine. I don't know if it's exactly billion, maybe it was some 700, 800 million. But now it has brought it to at least a logical conclusion. 235 billion pre-IPO, now 65 billion. Have they announced a pre-IPO yet?
No, what I don't understand is how it could be worth 1/4 what it was worth 2 years ago. What does that mean?
Oh no! Oh, this is. I am not surprised. I mean, this is what. So when Ant was trying to come out with an IPO, that was, I think, around October 2020, if I recall correctly. We talked about that in the session, and that time, it was. I don't remember it. I guess that's right, $235 billion. But that was the phase when every company was being highly overrated in the markets, right? And many of those companies, pre-IPO companies, have corrected their valuation. Not just Ant Financials. Look at Klarna. What happened to Klarna from 40 billion to now 10 billion, right? Look at which other companies are planning to go IPO. I think Databricks, some point of time, 42 billion. Now they're looking at close to 15 billion. So the markets have corrected, the multiples have corrected. For the pre-IPO companies, the tech companies, the multiples that were being accorded were around 40, right? I didn't check what's the latest one, but let's see. And now I know I didn't see, maybe let's see what's in the latest one, July 17th, right? From 40, now the overall median is now 6 revenue multiples, right? So things have changed in the markets. The business may not have changed, but the multiples that the market is willing to accord to these high growth companies, that has changed. Maybe there's a chart, right? So around 2020, if you look at these high growth companies, enterprise value to next 12-month revenue, this was close to 20x on as a median level, right? Now all those have gone way down. From 20x, it's now close to 5. So the valuations have just contracted. And that's why from 235 billion, now if they go to IPO, probably 65 billion. So I'm not surprised with that. It's how the markets have corrected over too much of excess liquidity pumped the markets, and now it has gone back. Yeah. Look at this chart. Top 5 median companies, their valuation in 2020 and 2021 close to like 60 times of their revenues. Snowflake was one of them. Snowflake at some point of a time was trading at 80 times of their revenue multiple. Right? I don't know where Snowflake is now, but I'm sure it is nowhere near to where they were. Right now, it's what price to sales is 25. Still super expensive, still not cheap. But from 80 to almost 25, it's just markets is not willing to give the same amount of a multiple anymore to these companies. So that's what happened. I don't think so, but the fact that now they've been fined, hopefully there will be now this is the last one, and that there'll be a resolution. So Alibaba, which owns a big chunk of Ant Group, basically the same founder, Jack Ma, founder of Alibaba as well as Ant Group. That's what the Alibaba shares were up 8%, saying, gosh, now we know. Now at least it has reached to a logical conclusion. We don't have that uncertainty clouds. So the markets don't like uncertainty, right? Even if the result is against you, market is still okay because finally we have the end result, right? So that's what caused, I think, jump in Alibaba shares also, saying we now have a decision on end growth. We also saw Alibaba was fined, I don't know, 2022, sometimes around that, for by Chinese regulators. And even when Alibaba was fined, the stock jumped even after the judgment came out. So that's what happened. I think every companies, every founders are in surprise of what happened to the valuation. Why can I not raise the money at the same valuation, not even at the half of that what we raised money in 2020? Yes, look at where the treasuries have gone. I think I do have a chart of treasuries. Let's jump over to there. Where's my treasury chart? It's a 30-year, 2-year T-bills. Their 2-year T-bills is hitting close to 5%. Those were close to zero over here. Now, if I'm an endowment fund, if I'm a pension fund, and we have, a hurdle of, let's say, 7 to 8% is what these funds would try to get. In 2020, there is no way they could have made that money without taking undue risk or without taking a huge risk. And for that, I mean, because there is nothing on the treasuries. So the only way for these big pension funds or endowment funds, institutional investors, to make that 7%, close to 7%, is to use that money to put in the stock market. And that's where everything in the stock market went up. Now, I can make 5% by taking zero risk, almost zero risk. I mean, it's the same level of thinking which I use is, why should I invest in a stock market and earn on an average 8%? Median is, let's say, 10%, when I can get 5% risk-free. So that's the reason now what we are seeing overall markets decline was, hey, the treasuries are high. Anyway, that's whenever the treasuries are high, we see money coming out of the market, moving into the safer markets, because you don't have, if I can make 5% risk-free, that is way better than trying to make 7%, but bear the risk of the market. Hopefully that answers the questions. Okay. All right, coming back to this, something that caught my eye while I was reading this book. I'll probably share some more tidbits, but quickly want to go through this. I find it really, really interesting. Hopefully you do. Knowledge is overrated and wisdom is underrated, right? Knowledge means how much do you know? Wisdom is how do you apply, when to apply, what do you know, right? We see a lot of folks coming and talking on CNBC are pretty knowledgeable, but probably none of them have beaten their own tracker index funds, right? Intellect is overrated, temperament is underrated. I learned this one personally over the years. When I started my journey, it was all about, hey, intellect. I don't have a time to look into the market. I used to focus on what charts, candlesticks, Bollinger Bands, a lot of other stuff, looking at the ratios, financial ratios, leverage ratios, your debt to equity ratios. I probably went through all the financial ratios. I thought that's what is important for me to become a better investor. Over years, now I realize that your temperament, your EQ is way, 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 way more important than your IQ. And the best example of how EQ generally trumps over the IQ is long-term capital management, LTCM. I'm sure if you are interested in stock market, you might have heard about story of LTCM. Everyone who, okay, let me ask a question. LTCM, what is that LTCM? What's the story about LTCM? Everyone knows about it? So, it predates me. It's, I think, early 1990s, right? I wasn't investing in the market by then. I was probably in my high schools. But LTCM was it's a long-term capital management. It's a fund. They had 2 Nobel Prize winners as a part of their team. It is said that anywhere across, LTCM had the most IQ per square feet that you can find anywhere in the world.
Vivek. More or less what happened is they got nervous and they went off their doctrine of running things. It's just like the nuclear. Rather than going their safety, the people lose their nerves and they just pick up they just do they go into emergency mode and they messed up.
Yeah, bingo. Yeah, you got it. It was so there were 2 Nobel Prize winners who understand, of course, since they're Nobel Prize winners, probably they understand the economics and how the markets move the best than anyone else would, right? And 2 of them were if you're in options, you would have heard about Black-Scholes model, right? So those 2 were also part of LTCM team. And they were running sophisticated algorithms to basically, run those automated trades. And the idea was, hey, these will always make money, right? So from an intellect perspective, no dearth of intellect. Like I said, it's the maximum IQ per square feet that you can find anywhere in the world. But they leveraged too much on, their exposure was against, I think, US treasuries. Exposure is fine, but where the EQ comes in is how you control your greed or leverage. What killed them was not IQ, but I would say the temperament, the nerve, or the inability to control the greed. And the fund just went belly up. Time and again, we have seen this. It's not IQ that matters, especially if you're a retail investor. There are way more easier way for us to just go and pick index fund or pick any good company. But the idea is, how do you be emotionally stable to reap the benefits once your thesis works out? Most of the people will chicken out in, and I see this around my friends and family, right? A lot of some friends who became investors, air quote, in 2020 are no longer there in 2022, right? It's all temperament. 2022 was a bad year for the market, and most of the friends probably have either are not interested, and I hope they haven't dumped their holdings, because the holdings have come back in 2023. Many of the stocks have recovered, not fully, but some of the stocks are up 100% from where they were in 2022. But if you dumped everything in 2022 itself, you're not there to reap the benefits, right? So I feel IQ is way more, is given way more importance than the EQ, which is, I just don't understand. I think the EQ is way more important. Outcome is overrated, process is underrated. Maybe we'll do only half of it. Rest half we'll do next session. Right? Yeah, outcome is overrated, process is underrated. You go and talk about the stock market or investing in general. First question people ask you, what's your return? Right? And that's one of the stupidest question that I think you can ask anyone, because the absolute returns means nothing. Even if you want to know the return, the subsequent question should be, what's the return with respect to the risk that you have taken? I could come and say, I made 100%, I made 50%, I made 20%. Right? That doesn't mean anything without you knowing what's the commensurate amount of risk that I've taken. If I have made 50%, but I have taken the risk. If that risk materialized, could blow up my account, that 50% is worth nothing. Maybe it's better to make 20% and de-risk your portfolio so that if the market goes against you, you're still not blown out. Right? But people will put way more importance on, hey, what's the net number that you made? Right? Without understanding how you make that number, what's the risk you have taken, does that increase your longevity in the market, or is it like a one-time something that clicked in one time? The way like 2020. Sure, every investors in 2020 would have made 40%, 50%, 80%. Right? Not every, but I guess most of the new folks who came in. But how many of them are still around? So process is underrated. So don't pay too much attention to, either if you're on FinTweet, on YouTubers talking about how they made 50% or 80%. Yeah. You don't know, they could be blown out the very next day. Short-term performance is overrated. Long-term adherence to investment philosophy is underrated, related to the same above. Gross return is overrated. Stress-adjusted return is underrated. I focus a lot more on this, and I think you've heard me time and again, there is no investment worth losing sleep. Stress-adjusted return is what I want to focus on. If I were trying to make higher return, but that causes me to take undue risk, which causes me to lose sleep or take additional, undue stress, I'm not for it. And you'll not hear those so-called hot tips from me. Right? For me, it's stress-adjusted return is what I want to focus on, because that will also increase the longevity in the market and will help you to reap the benefits of the compounding. Upside potential is overrated. Downside protection is underrated. How many of us actually think when we're trying to invest in the stock, we always think about, can this double in next 1 year, or how, where can it go in next 4 years, 5 years? But few of us only think about what are the downsides of owning this stock. Right? For us to be a good investor and a better investor, we always have to look and invert our investing thesis and say, hey, where can it go wrong? And then how do I protect myself if that goes wrong? Maximization of returns is overrated. Avoidance of ruin is underrated. Many stories we have discussed in these sessions in terms of someone trying to maximize the returns have just blown up their accounts. Growth is overrated. Longevity is underrated. PE is overrated. Duration or competitive advantage is underrated. And I guess now this is starting to change, I believe. So plain value investors will focus on PE, try to pick up the stocks with a lower PE, right? Something called cigar butt investing. I think the companies like Amazon, Netflix have now started to change that thesis, saying even if you have a high PE, but if you have a competitive advantage, if you have a moat around your business, you would still do good. Yeah. Categorization of stocks into large cap, mid cap, small cap is overrated. Categorization of business into great, good, and gruesome is underrated. This is where I want to focus more on stocks versus the businesses. All right. Hopefully, now we have warmed up for the session. I generally, if I've done some good reading, I do want to come and share. I believe over long term, these things help way more than identifying a particular stock. These things helps for us to reap the benefits for the stock. All right, let's go back and see what happened last week. We've gone back to the same old fashion of good news is bad news for the market. So the jobs number were stronger than expected. And that means markets on, I think on Thursday, they fell down thinking, oh, it means Fed will continue to raise the interest rates. And when Fed, if the market think Fed will continue to raise the interest rates, that's not a good sign for market. So we saw market fell down on Thursday. Friday, the jobs number were a little different. So I think over a long term, this really doesn't matter much. But what caught my eye was around how strong the services sector was. So I think I picked up, let me go back and see. The BLS report, if you look the BLS jobs report, recent jobs report. Not this one. Where did I see the total number of jobs added? And there were jobs removed. Anyway, looks like I can't find the report right now. But I was looking at the jobs added and the jobs, shed off by the companies. Leisure and hospitality were where the maximum gains were coming. And there were still 2 or 3 sectors where we saw net loss of jobs. So IT or the tech sector, almost 30,000 jobs lost in over there. So that's still having a tough labor market is the IT sector. But we see the services continue to expand while manufacturing is weakened. Other indicator for leading chart is inflation continues to abate, right? Which will be good because that's where Fed wants to go, is they want to bring inflation down to their 2% target rate. And the leading indicator, which is manufacturing index as well as the services index from ISM, both are trending in the right direction, which is lower. So eventually this will translate into the CPI a few months or quarter down the line. That means it'll be good from the Fed perspective, that where they are trying to reach out to their 2% inflation. So what does this mean for market? Strong labor market means the Fed may keep the ultimately interest rates higher. And Jerome Powell has come and talked about it multiple times, right? Higher for longer. Ramesh, thank you. Yeah, that's the chart. So IT shed 30K, manufacturing shed 42K, leisure and hospitality added 232K. So now the investors are expecting Fed to raise one more in July meeting. And this is despite the fact that the Fed chairman and I think some of the other Fed governors have been coming and talking, saying we're going to raise it 2 times. But market still thinks they're going to raise it only 1 time, which is in July, and then keep them there until May 2024. And maybe next year we may see some rate cuts, right? Who knows? These things can change after new data that'll come in, but it is what the market is currently pricing in. So given the fact that we are expecting a little more higher rates in July, and that will continue to stay at that level for almost next 9 months, the treasury yield started to climb. So this is where we have a 2-year versus 10-year. 2-year is close to 5%. I mean, this is something that we just talked about, is if you can make 5% with 0 risk, why do you want to go somewhere else? And 10-year is now close to 2%. Sorry, 10-year is almost 3%. Right? So far, SPY is up 15% year to date. QQQ, which is a tech focus, is up 39%, which is amazing. All the stocks that were beaten down in 2022, which was the tech sector, was the worst hit sector, has now recovered from its lows of 2022 to up to 39% year to date, which is amazing. But what has not worked so far is small and medium businesses, right? IWM, Russell 2000 index. So that's up only 6.5%. So, oops, we'll come back to this chart. So if you look at overall sector perspective, right, tech is almost 40%. What hasn't worked out in this year is energy, utilities, healthcare, financial, and staples. When I was looking at this, I'm like, all these are the sectors which are actually pay dividend also, right? So dividend paying so-called defensive stocks haven't worked out this year when I look at the stock price perspective. Energy is down almost 8%, utility is down 8%. It's not that we are not consuming, the consumption of the utility has gone down. Of course not. But just as the market, a lot of money has gone into the high flyers tech. So they have gone up 40%, while these sectors have been stopped. And the on an average, the stock prices are down 2% to all the way to 8%. But does that mean, is it a time to maybe start looking at a dividend stock? Because right now, some of these dividend ETFs are not as pricey as some of the other stocks have already been, right? I am finding it very, very tough, and you can share what you think about it, to put more right now into the tech side. It's up 40% for a year, driven mostly by the big tech companies. Look at NVIDIA. NVIDIA is up what? NVIDIA was up almost 200% for the year. Right? It's close to 140. Now it's up to almost 425. Meta is up more than 100%. Right? Apple is now $3 trillion company. So I've been thinking, and maybe any additional money, I don't think I'm gonna put it in on the tech side. Maybe is it time to start looking at the dividend stocks, because those stocks haven't performed well, but it does generate a dividend income. And if the market turns around, could we see a rotation of money moving from the sectors that have worked in the first half of the year to the sectors which are more defensive in nature: healthcare, utilities, energy, financials? Is it time to go in dividend? So I was looking at some of the dividends list. I don't know, you might have something, your own favorite, but here's some list of the dividend ETFs, sorted by the asset under management, total asset under management. Vanguard dividend appreciation, I see this being very common. SCHD, my favorite is SCHD. Not a financial advice. I mean, you can pick up whichever you want to, but I'm strongly looking at maybe a dividend stocks for, any additional money I'm trying to add, right? Either add into the individual stocks in those sectors, or maybe if you don't want to take an individual company risk, maybe a dividend ETF could be another option. So the go-to is ACHD for two reasons. Number one, it has got a very low expense ratio. Number two, it has a decent amount of options activity in this one, right? The other ones, VIG, VYM, are not that good when it comes to options. So for me to reduce my cost basis by selling either covered calls, or by trying to acquire shares at a lower price by selling put or a put spread, doesn't work that great in let's say VIG. If we look at its option side, options are not that great on VIG. SCHD is a lot more tighter bid-ask spread when it comes to options. So that's what I use as my vehicle. You could use whichever works for you, right? But maybe, and it's just maybe, market could continue to go crazy. Who knows? I mean, no one can predict where the market will go. But given the fact that some of these sectors are already up 40% and some of the stocks are up 100%, 200%, maybe time to take a contrarian approach. Right? And that reminds me of this thing, something that I read. I say question, does this site show fee and if option is offered in the ETF? So the site I was, I think, is a pretty common site. This is etfdb.com. Let's see, does it show, is it optionable? I mean, even if it is optionable, I think we still have to go and look at, how tight the market is, right? So optionable, but it's a very low liquidity market, and wide bid-ask spread just doesn't help. So when I started looking at these dividend aristocrats, so I looked at VIG, I looked at NOBL, because that's got a dividend aristocrats in it. Dividend aristocrats are the companies that have increased their dividend for last 25 years, not just maintain, not just giving the dividend, but increase their dividend every year, right? So it means it's got some best dividend paying companies, but NOBL is not that good when it comes to the option. So if I have to look at option side, I again come back to whatever the brokerage firm you have to see how tight or how liquid the options are. Freddie says same with QYLD, JEPI, JEPQ. Yeah, JEPI, JEPQ, I've been seeing a lot more of these in my Twitter feed. Some of them have like, what, 10%? But these are I think these are the ones which are covered calls. Hold on. I forgot which one was which. Is it JEPA is a covered call, or this is from a JP Morgan? I think one of them is like sell covered calls on tech stocks. Yeah, this JEPA dividend yield is 7.9%. Yeah, so yes, I've been hearing about GEPI, GEPQ from also from a dividend perspective. But if these are the, let's see the summary, if these are the ones which are investing in the tech sector, then I'm actually trying to diversify out of a tech. Does it? And maybe Fred, if you know which one was a tech sector, can help us. But I think one of them is covered calls on the tech. So while you may continue to get your dividend, you might lose on your capital if the tech goes down. ACHD is a pretty well diversified, let's say JEPI holdings. JEPS will fine. So it has got 13% in tech. Yeah. I don't know what's its expense ratio is though. Regular time.
आज वो होज निकाल देना होज निकाल देना
So yeah, JEPI, JEPQ, ACHD, VIG, these are all some good dividend paying ETFs. Again, if you are a dividend, if you want to look at, take a little contrarian approach wherein all the growth stocks have performed this year, and you want to go and look at, hey, I want to look at something that has not performed. And I generally want to take little bit of contrarian approach is if it is on, I don't want to buy things which on the day when they are green, want to buy the things when they are in red. the business is fine, but hey, on the day when the stock has fallen down for whatever reason, that's the day I'll buy the stock. So I'm looking at, gosh, the companies like these dividend paying will have a companies like Home Depot, AbbVie, some of those companies that have been doing great for years. The stock price, the business, but this year the stock price hasn't worked. So maybe it's a time to buy those. Again, not a financial advice, just my thought process. So I was reading about this, not reading, I think I listened in some of the podcasts, and that blew my mind. So if you had invested $100 in Altria in 1972, yeah, it's almost, 50 years back. That is worth $18,000 now, which is great, right? Converted your $100 into $18,000. Even if you have done nothing, but you just held the stock. And Altria is a good dividend paying stock. And you had not reinvested dividend. This is just the stock appreciation without considering the impact of dividend. But if you had invested every dividend back into the stocks, right? DRIP, dividend reinvestment plan, DRIP. But if you had reinvested the dividends, what do you think that would be worth now? Take your guesses. Any guesses? Pick up a number. Come on. It helps to average on your cost, yes, because brings down your cost basis of the stocks. But and helps you to, buy additional stock. Now that additional stock that you would have bought by reinvesting that dividend would have helped to increase the total number of shares, and those shares would be worth now, hold your breath, $2.5 million. 500K. Yeah. This was a stats which just blew my mind. I had to actually reverse it and hear that podcast again. I mean, is it really? But we all know Altria has been one of our great investors. I mean, it's a cigarette company. And this is when the fact that the consumption of cigarettes, and tobacco have been going down ever since, I think, 1980s, 1990s. I'm not exactly sure when it started to go down in US, but when the Surgeon General of USA talked about the issues, I mean, the effect of smoking to the health, the consumption of tobacco has been going down. But Altria has been continuously paying dividend, increasing its dividend. And if you had invested that, gosh, my dad has just invested $100 in my account and bought Altria with a DRIP. I could retire by now. Right? That $100 has now amount to $2.5 million. And Altria is now caught up in ESG nonsense. Yeah. But I think from a return perspective, it's been a great stock. Even though the consumption of its a product is going down, it continues to pay dividend, buy back the stocks, and hence increasing the value of the remaining stocks for the investor. Look at what Apple is doing. Now, if you look at Apple hit a new all-time high, right? $194. It was above $3 trillion. Or what happened to Apple revenue? Not moving much. From a revenue perspective, Apple hasn't done much, but it continues to pay dividend. It continues to buy back its tons amount of shares. Now Apple is about 40, almost, this is the biggest stock in Berkshire Hathaway portfolio. It's almost 50%.
Vivek.
Yeah.
I first bought $26,000 of Microsoft stock in 2006. So then a couple of months ago, they said someone who bought it in 2012 bought about 20,000 should be a millionaire. I'm thinking to myself, how come I'm not a millionaire? Yeah, I was listening to everybody say diversify.
So I have two thoughts around that, diversify versus others. Is if you want to build insane amount of wealth, you have to concentrate. To preserve the wealth, you have to diversify. Again, I'm not a financial advisor, but that's my thesis is, and look at anyone else, right? So who are the richest people in the world? Are mostly the founders of the companies, right? Jeff Bezos, Elon Musk. Where is Elon Musk most wealth is? It is in Tesla, SpaceX, and whatever the companies own. Very well, very concentrated. Right? Bill Gates, Microsoft, completely concentrated. Right? But then for us to build insane amount of wealth, the equivalent amount of risk is also there. What if you put all your money into Yahoo in 1998? You know, Jerry Yang, let's say another founder. Jerry Yang was one of the founders of Yahoo, made insane amount of wealth, but now that has that has just evaporated. So that comes with a huge risk. But to build wealth, we need concentration. Now you can determine what level of concentration works for you, depending on what kind of a risk you are willing to take. But then to preserve it, you have to diversify it. And otherwise, building wealth takes time, which is fine. If you have a good patience, if you have a 40 years for before you want the money for retirement, I don't think there is any need to take a huge amount of risk. Right? Even if you put it in S&P 500 index fund, will still do fine. Right? But we can't build insane amount of wealth if you're diversified. It's always a balance between your return and the risk. Right? Now, those who, let's say, bought only Altria made huge amount of money, but the huge risk is, and I'm sure probably none of them would have kept their stocks, if they bought at 100, 90% of them would have actually sold the stock, when that 100 became 10 times. People just don't have patience. And number two, imagine in 1980s, 1990s, 2000, everyone is against the cigarette companies. You would think that the future is zero, right? There's no future of these companies. So yeah, these stories are great, but I think a lot more, as an individual investor, we have to decide how our gut behave when we see the negative news around the companies that we hold in portfolio. This is the Berkshire Hathaway's portfolio. And let's look at this. Apple is not yet 50%. Apple is 47% of Berkshire Hathaway portfolio. Now this becomes huge. It's a concentrated portfolio. 50%, almost 50% in one stock. Right? But Buffett is not, or Berkshire is not a kind of organization which will, just sell off a company if they don't perform in a year or two. And forget about everyone else. Buffett entered into Apple in 2016. It's not even, and not that
Vivek,
he got it Apple way earlier.
Buffett sold off TSMC within a year.
Yeah. TSMC because of the China stuff. So I'm aware recently they have taken a decision which are very non-Buffett-like. TSMC is one, getting out of airlines was another one, bought gold in, I think, 2020 or 2021, sold it out within 6 months of buying the gold. There are a few decisions which they have recently taken, which is different from what you generally expect. But I think on and overall, they're still buy and wait it out. Right? So So Apple is still like 47% of Warren Buffett. For me, it's not such a big portion of my portfolio. I'm a conservative one. I don't have the risk-taking capability of concentrating my portfolio too much, right? So I won't be able to do what, let's say, Warren Buffett does. But if some of you, if you are just starting your journey and you have like 50 years ahead of you, 40 years, I don't have 40 years ahead of me, right? So everyone's life is different. So please don't follow anyone and don't follow anyone else. Your portfolio is just what is suited for you. But just wanted to show the power of reinvestment and compounding on some of, the stocks. So all trades won't go. All right, ESG is caught up in nonsense. ESG didn't. Now, over the last few months, this whole ESG stuff has now like kind of dying down. It was all promoted by BlackRock, and many of the red states are now putting some limitations and not allowing the pension funds from the state to invest in BlackRock because of BlackRock forcing companies to around the whole ESG stuff. Sometimes I feel this whole ESG stuff is making a lot more money for the lawyers than being good for environment. There was one, I think, one article in Europe or somewhere. One of the oil company ESG score is higher than Tesla. Okay. So you can always game these scores, looks like. So I think this is makes a lot of more money for lawyers, for attorneys, for these class action lawsuits, those lawyers, than for environment. So anyway, a couple of charts, 2-year, 10-year, a 30-year mortgage is above 6% still, right? So a little bit pressure on the housing side. Fed balance sheet, yeah, it is starting to come down, but a lot more. It has to come down a lot more. I don't know whether Fed will continue to reduce its balance sheet. In China, we are starting to see that it's moving in the opposite direction. So depending on what markets do, we may see more money coming in. We saw this one little bump up higher in between because of the banking crisis. Yield curve, which is, if there is any predictor of a recession, the most reliable is the one which is yield curve. It is still inverted. Now I think this is inverted for a good amount of a time to be a decent predictor. It also inverted in 2020 for a little while. I think it was right over here, right? But wasn't significant enough. It inverted a little bit over here in mid of 2022. Looks like around April 2022. But now the magnitude of inversion as well as the duration of inversion is long enough, and that is there's a lot more talks around recession, soft recession, hard recession, we don't know, but definitely some sort of recessions may be in play. With that background, if I look at S&P PE ratio, today is 25. Still is way higher than the average. CAPE ratio, which is adjusted for inflation over the last 10 years, is around 30. So I'm a little cautious on overall the markets today. Right? I think it's 2 or 3 weeks ago where we looked at equity risk premium. There's not much premium in the markets to take equity risk. That doesn't mean that, hey, the markets will go down tomorrow. Markets can continue to stay irrational. There is a famous saying, right? Markets can stay irrational longer than your portfolio can stay solvent. So markets can continue to stay irrational, or tech stocks can continue to go higher, and maybe few stocks can continue to drive S&P PE. maybe even to a higher level. No one knows, but to me, it seems to be very expensive. To me, at least looks like the premium to add additional incremental money is not that much. Well, I'm not saying I'm going to take out and sell off my portfolio and convert it into cash and put everything in treasury. I'm saying the incremental dollar which I'm bringing in, the premium that the premium that I could get from an investment in equity versus a risk is not that good right now. But 401k, yeah, I'll still continue to go to SPY. Right? Others, maybe I'm holding off and continue to build my T-bill ladder. So yeah, this week again, I added a little more on T-bill, 17-week T-bill. Next week, another one goes in 26-week T-bill. That's outside of my 401k. Anything that extra money, yeah, let's put it in, risk versus reward. It's all a question of risk versus reward. Other thing that caught my eye was, what are we hearing here? This new gold-backed currency by BRICS, and this got all the crypto, the Bitcoin maximalists were all out, because if BRICS, which is Brazil, Russia, India, China, South Africa, now the overall GDP of all the BRICS is now higher than G7. And I think from an overall trade perspective also, it's a big enough percent of global trade. So there was a news that the BRICS is set to introduce a new currency backed by gold. Right? Now, how much is truth in this one? No one knows. Nowadays, it is so hard to believe anything that you see on internet or on Twitter. Then I started digging a little deeper into it, and I saw a few more articles that this has been talked about since 2020. And then I saw another one which came out 3 days ago, which says that the BRICS company have a BRI separate, a bank, and the CFO says we have no plans to issue a new currency backed by gold. So you don't know who to believe, right? So be careful when you're reading through it, especially the feedback or the comments from people is, I don't know if it is even true. Number two is, how are you gonna validate the veracity that those are indeed backed by gold? And we've been on this path earlier also, right? If Russia says that the ruble that they've introduced is backed by X metric tons of gold, how are you going to verify? Or these BRIC countries. So again, take it just on a face value. Don't read too much into it. I don't think it's going to happen anytime soon. I mean, they say that we're going to announce it in August. We'll see how this works out, but I am not becoming bearish on dollar immediately. Over a long term, yes. If you read Ray Dalio's, I forgot which book was it, in which he has reviewed over the last 500, 600 years of the rise and fall of nations and the rise and fall of currencies. Every nation, and hence its currency, has a lifetime of around 150 to 200 years. Starting with Netherlands guilders. They were the most stable and the most powerful currency in the world in 1600s. Then came the empire, the British Empire. Right? And prior to Netherlands, I think it was some Chinese currencies. So there is, maybe I can find out a chart in some other session, we can share it. It tracked down that generally a nation has longevity of 150, 200 years. After that, it sets into decline. And US has now closely approaching that time period, right? Maybe 150, maybe start of 20th century. Now we are close to 125 years, has been the year of US, right? After, let's say, after First World War, 110 plus years. So, and after being successful for so many years in the decades, the kings, monarchs, and now the elected representatives or the heads of these governments start to make a decision which are irrational in long term, which is what the US has been doing by this money printing and all that. But that doesn't mean it's going to just decline tomorrow. Over a period of time, yes, someone will overtake US. I have no doubt about it, but I don't think that's probably going to happen in my lifetime, maybe the next generation lifetime. So yes, US dollar has been in decline, but I don't think there's a need to panic right now. So, but there's a lot of sound bites around this BRICS stuff. Fear and greed index moved back into extreme greed after Friday. Crypto side, still okay. Mostly driven by, if you look at the last 2-3 weeks of all the increase in the crypto side, it's been driven by BlackRock, right? Now BlackRock has come back because now one thing is very clear, is institutional investors, hedge funds, etc. They don't have any particular principle-based standing on their own. They will go wherever they can make money. We have seen this time and again. Now, BlackRock is now, those who are new, maybe I'll repeat for you, they recently filed an ETF for backed by Bitcoin, spot Bitcoin, not the futures Bitcoin. Futures Bitcoin ETF already exists. And it's been, what, 2 weeks now? And after that, I see Larry Fink coming and now singing praises for Bitcoin as a digital gold and how is it good and all that stuff. And this is the same Larry Fink who in 2017 or somewhere was saying this is index of money laundering. But now they say that their clients are demanding it. They can make huge money on the spread by selling it to their clients. Oh, let's do it. Right? Now let's get into Bitcoin. And that's what has been driving all this, I think from almost 10-15% run up into Bitcoin over the last 2-3 weeks is because of BlackRock. And BlackRock is the biggest asset manager in the world. We'll see what SEC does to this application. Right. All right, the last thing before we jump on to, before we jump on to our managing option trade is, like I always do, at the end of a month, in spirit of transparency, I do come and share what my top holdings are. So far I've shared top 10, but from this month, I'll share top 15 so that you know when I talk about certain stocks, is it because I'm trying to pump up my bags or anything like that? So I just want to be transparent. I'll give you a couple of minutes to look into this. My top 15, end of May, end of June. I don't think anything has changed between the top holdings. Maybe some places have gone up and down depending on where some stocks have moved. But overall, the position is still the same. SPY continues to be the top leader. Second is the cash. When I say cash, it does include my T-bills because I can't find right now much better use of, not too many opportunities I see in the market, except let's say some dividend or some energies, etc. So I'm comfortable holding good amount of cash in my portfolio. Gives me, allows me to sleep well, right? Maybe I'll miss out on some percent of portfolio, but this is where your stress adjusted return comes in. Having healthy amount of cash increases my stress adjusted returns. May reduce my absolute returns, but increase my stress adjusted returns. Things like flash crash is coming, I don't have to worry about it. Okay. Apple, Microsoft, Mercado Libre, Meta, QQQ, yeah. Still holding all these in my portfolio. These are top 15. Whose portfolio matches with this? How many of you, how many of these stocks do you have in your portfolio? Let's say top 5 or top 10. Anyone wants to share?
I have a comment on the T-bills. Have you noticed how they only hold back 1% for margin on the T-bills?
Actually, I on the T-bill side, I'm not doing it on my margin account.
Okay.
So just straight up
But
from my bank account, I moved into my basically on Treasury Direct. So I'm buying it directly from Treasury Direct. I just want to keep that separate from my brokerage account. But
Okay. Yeah,
but
if you do it in the brokerage account, maybe it depends on the type of account you have, but it may be as low as 1%. The Tasty only holds back 6%. So the rest they free up to use for something else because
yeah,
it's a safe investment.
got it. No, good to know. Yeah, I didn't want to bring it onto my brokerage because again, then I just wanted to keep it separate. So that's completely directly on Treasury account. Tesla, no, I have not yet bought Tesla. So I was very close to buying Tesla 2 weeks ago to start a position in Tesla. I don't even have a Tesla in my portfolio. Not in top 10. I don't have anywhere Tesla in my portfolio yet. I don't know why. I've been watching it. I've never been able to pull plug on Tesla, except I think last 2-3 weeks where I think it's a business is now doing good. Of course, I've become a lot more positive on Tesla business than what I have been over the past few years, but haven't pulled the plug yet. Sorry, I have all the stocks plus Tesla. What is the difference between the first and the second column? Oh, this was how it was end of May, and this is end of June. So I compare with anything has changed since last month. Sometimes you will see that some of the stock has dropped off and some other stock has come in. It could be either I added to position or maybe the stock has run up too high, right? NVIDIA was not in top 10 earlier. But then given the growth in NVIDIA stock over past few months, it moved into top 10. So that's the difference between the first and the second, just a comparison. Cool. All right. Yeah, it does. Okay. Other thing, it doesn't include my 5 to 9K emergency funds, right? It's just retirement and the brokerage stuff. So what did I buy or sell this week? I bought XLB. It was red. I have some position in XLV, but I wanted to increase my little bit on the healthcare side so that I wanted to also add more so that then I can start selling more options, covered calls and stuff against that. So bought a little bit more of XLV and know the stocks selling. And from option side, aggressively closing my July expiration trades, because now if you look at July, where we are July is only 13 days out, right? So any trades that are profitable probably have already closed it. The things that are still working out, either I'm trying to manage them, is what I'm still holding it, or if those are defined risk trade, maybe just waiting for another week to see what happens. Otherwise, I'm gonna either roll them out or either close them for a loss or manage it, right? So but all new trades that we're building is only for August expirations. No more July expiration new trade. Too less a time in July for this, right? Too much of a gamma risk. So that's so far. Let's jump onto the managing of option trades. Before that, if any questions, and I'll sip some water meantime. All right. I see. Nice picture. That's a funny one. Real estate 401k imploding, soft landing. 2023 collapse. Yeah, I don't know. I mean, see, it is so difficult and impossible to predict what market's going to do in next half of 20. No one would have thought that market will be up 15% in first half. Wall Street didn't think about it. Many analysts in the Wall Street, they are also surprised by it. Does that mean it's going to go down in next quarter? I don't know. Right? But we can only, or at least I can only think about saying if it's done 15% this year on an average, even if we pick up the best years of the stock market, right? Probably it may not grow at the same rate. It could still grow and maybe end up at 20%. That's not out of a bounds, or up 30%. I think in 2019, it was up 30%. So that's not out of bounds. Right? But depending on, how much, what kind of stocks you have, how much is in your portfolio, what else you hold in cash, when do you need money? Some of us may be trying to not take money off the table, right? Let's say, right, take your gains. Or how would you feel if after you've taken your gains and the stock market goes up another 15%, because it has done earlier also. Right? So that's what you have to think about. So I'm not taking my gains out. Yeah, I'm trying to add more and more negative delta trades so that I can at least earn on theta. And if the market continues to go higher, fine, I lose on my negative delta option trades, but will gain on portfolio. It is impossible. I mean, this is a market wherein you never know which side will it go. But that's a fun part of being in the market. If everyone knows where the market is going to go ahead of time, then what's the fun? All right, let's talk about managing option trades. Can we have a session on how you and others sharing what type of scripts some of us are using on Thinkorswim? Sure, I can share what scripts I use. And now with ChatGPT, it's way easier to now create those scripts. Yeah.
Vivek.
Yeah.
I thought ChatGPT was from information before, I think, August of 2021. Or are you using number 4?
No, so that information will be, something which is tied to a date wise, right? But what I was referring to ChatGPT is to create the Thinkorswim script. So that is not dependent on the date perspective, right? If you understand, let's say if you understand Python, I'm asking it to create a program in Python. So that is date independent. Yeah. So ChatGPT 4, I don't know when was the last ChatGPT 4 has been trained onto. I know ChatGPT 3 was trained up to, I think, 2021 or 2022, somewhere like that. ChatGPT 4 is probably more recent. But yeah, I used, I think, 3 or 4, whichever, to get some help on writing TOS scripts. All right, so let's get on to managing the option trades. So I think I do have this somewhere. So let's bring that up. Cool. So now this is in continuation of what we talked about last week, was how to get into trade. So now you got into a trade. Now the trade is going against you because you never know. I mean, it's, at the end of the day, options is probability. And that's why I love options. It's not a deterministic way of trading, right? I don't have to take a stance that, yes, if I've done this, market has to go higher if I'm taking a long position for us to make money. Or if I've taken a short position, market has to go lower for us to make money. Right? Stocks are deterministic. If you buy a stock at $50, the only way you can make money is a stock moves up, moves above 50. There's no other, or if it pays a dividend. Right? Otherwise, in option, you could still be bullish. And even if a stock moves a little lower, you could still end up making money. But at the end of the day, it's a probability, right? So while you did a trade which has got 70% probability of success, stock has 50-50, right? It's either up or down. It's 50-50. Options, you can define your probability of success. I generally want to do with a probability of success of 70%. So they have a better chance than a coin flip. But at the end of the day, it's a probability. It doesn't mean that the next trade which I've done will have 70%. Maybe the stock goes against you and that trade is now challenged. So how do you manage that trade? So first of all, why we want to manage the trade? So that we can convert maybe a losing trade back into a winning trade. And over the years, I've done this multiple times, wherein if I'd just not done anything, probably I would have lost on that trade. But because I was able to manage it, and we'll go through some of the steps of managing the trade, how you can manage some of your trade, you were able to collect enough premium that even though the stock has gone against you, you were still able to come out positive, right? May not happen in every trade, right? But you could convert your losers into winners. More important thing is without taking additional risk, without adding additional risk to the trade. Second thing is, even if you're not being able to convert it into a winner, well, at least you have reduced your loss. As the stock has gone so against you, it's not possible to convert it to a winner, but now I can, scrape whatever I could to maybe come out with a lesser loss. So this is why we should manage the trade and not just put on a trade and wait until expiration to see what happened. Did I win? Did I lose? Right? Maybe keep an eye and see if it is gone against you. Learn, figure out how you can manage some of your trades to either convert the losers into winners, or if not, maybe reduce your eventual loss. More important thing is without taking or adding additional risk to the portfolio. First technique. Okay, other thing I want to emphasize before I jump into this is all focused on us as an option seller, right? Not an option buyer. I don't do, especially for the new ones who joined today, I don't do much option buying because that doesn't work long term, right? Talk to any professionals. It's buying works once in a while, great lottery tickets, but doesn't work in a long term. So I'm mostly an option seller. So anything that I'm talking here today, most of the time, if it's from the context of that I've sold an option. Do I buy options sometimes? Of course. I bought some VIX call spread to reduce my delta, recently, because the VIX was like below 15. And that is just to get some protection against market drawdown. So yeah, I'll buy some leap option, but that's more of a stock substitution trade, not as a way to do or generate income from pure options. So there are times when I'll buy options, but most of the option trades, regular option trades, will be all option selling. And so keep that context in mind when we talk about anything related to options here. So first is time is the best healer, right? Maybe give your trade a little more time to cooperate. Let's take an example. Maybe I sold a put for July expiration at $50, and not July is already now 13 days. Let's say I sold a put for August expiration at $50, and now the stock is at $49, right? So just from an option trade perspective, that's all becoming a little losing trade. But how far is August? I still have a lot more time. I have a 41 days before the August expiration comes in, right? Just wait. But if I'm a July one and this is being challenged, then all I need is, gosh, I think the stock, my thesis on the business was right. I'm not right, but I have more conviction on thesis, and I think the stock should go higher. I gave myself a little room for error by selling a short put, and the stock has even breached that. Maybe I just want to get more time, and if I'm on a July one, I'll just roll it out to the next expiration cycle. Right? So if I had a July trade, which is what now, let's maybe build a trade here. Let's pick up Apple, right? And say I had sold, say, 195 put on Apple, and I had collected, whenever I sold, I had collected $2 of premium. Oh gosh, so it looks like we had to use this simulation for doing a lot more other stuff. So this trade would be currently is losing $200. But again, just an example, I don't think Apple will go higher. I'm actually negative delta on Apple when it comes to the option trade. But let's say, for example, let's assume if I were bullish on Apple, I sold 195 put, collected $2 premium. Right now, this is losing money, but I think Apple should go higher. Then I can just give myself more time, which means I just roll this trade out to August expiration, which means I buy the July back at whatever, $5, and I sell August expiration trade, same strike price, and collect additional $2.42. Right. So this is, I will basically buy the July and sell August. So earlier I'd collected $2, now I have $2.42 additional. So overall premium I've collected now $4.42. So what does that do for you is it will push your break even, right? So if it is just this, your break even is at 193. $195 put strike, $2 premium, break even is at 193. If a stock is below 193, the option trade is losing money. Now with this, what I've done is collected additional $2.42 in premium. So that pushed down my break even to, all right, give me some math, 193 minus $2.42. Now my new break even is $190.58. Right? So as long as Apple now stays above $190.58, this option trade will make some money before August, right? As long as by August it stays above $190.58. So this is how you either, you collected more premium, and if the, let's say, stocks comes to 191 or 192, even though it is lower than 195, you still come out ahead, right? Or if it does not come out ahead, you have reduced your loss by $2.42, right? So that's the first thing, is you roll it out to the next expiration cycle, and do this only if you are your thesis on the stock is still the same, right? You close your current month, July, and add a same trade for the back month, which is in this case is August, right? So we've gone through this example. I don't want to go. Its outcome is when you roll it out to the next month, you collect an additional credit. In this case, we saw additional credit of $2.42. Now your break-even has changed to $190. More premium, more buffer, which will move out your break-even point, right? And you get more time for stock to come back in your profitable zone. Stocks go up and down all the time without any change in business, right? So if your thesis is still intact, you could roll it out. And not, even if it doesn't come back in profitable zone, you lose less because you did this defensive management of the trade. Okay. So what's the criteria? When should you roll out? Should you roll out immediately? Because like I said, stock can go up or down anytime. So if your stock is undefined risk trade like this, if your stock is below your short strike, and now your current delta is twice the original delta. So let me explain this. Say when you started your trade, you did a short put at 30 delta, right? So it was 70% probability of profit. Stock has gone against you. Now your delta has become 60 delta or 70 delta, means the stock has now fallen from, let's say it was 190, it was 200. I did 195 short put. Now the stock is at 192. And now that delta is 60 delta. Now, yeah, it's maybe time to do to manage the trade or to roll it out. The third thing is if it is also, within 20 days to expiration. Because if this happening to the August expiration trade, I still have 40 days. I'm not going to go panic and adjust it right now. But if it is July trade, I only have 13 days. In that case, I will try to adjust it. Okay. It's a defined risk, then no need to adjust because we already know how much the maximum risk is in the trade. And we know that when we actually put the trade on. Right? So then let's stick to that and let the probabilities do their job. And if we take loss, we take loss. We don't have to roll it out. And the other thing is in rolling it out, a defined risk, which is, let's say, a spread, getting a credit it becomes challenging sometimes. And I don't want to roll it out and take a debit. That means I'm actually reducing the buffer on my trade. The other thing is if your days to expiration less than 21 days. If I have added some August expiration short put trade, I think I have a put spread on ASML, and the stock fell down the next day. I think I added that on Tuesday, Wednesday, a short put spread on ASML, and then on Thursday market fell down. It was below my short strike. My short strike was pretty close to at the money, so it was below the short strike. But I have still a lot more time for August expiration. I don't have to worry about it right now, so I'll wait. If the situation stays the same year August expiration, since in this case it's a defined risk, so I'm not going to do anything. But if it were just a short put, I'll try to manage. I'll see if I want to roll it out. Okay. The final is if you can do this roll for a net credit. We don't want to do it for a loss and put ourselves deeper into the hole. All right, other things. If you are doing this roll, when you're closing your July trade or the front month trade, you take a loss on that option trade, which is temporary loss. So don't shed tears on it, right? Because you've collected, even though when you close the July trade, you took a loss on July trade, but then on August, you took a lot more premium to cover for that loss already. So it's a kind of a intermediate loss. Number two is make sure your trade thesis is still the same. You are still bullish. If now you're turned bearish on the trade, then might as well take the loss and move on. But you are still bullish, then make sure, then you do want to have a bullish thesis trade. And that's why then you would want to roll it out and stay in a bullish thesis trade. But if your thesis has changed because something happened, right? Apple came with the news that they are reducing the total number of VR headsets that they could sell. Earlier, they were planning for 1 million. Now they have cut down that number. And if that changes your thesis on Apple, then guys, yeah, tough time. You can't win every trade. Take a loss and move on. Then no need to roll your trade because it doesn't align with your business thesis. Okay. So any questions on rolling it out? Some of you may already be doing it. For some of you, it may be a new thing. So feel free to pitch in with your questions if you have any. And we're doing it a little differently when it comes to rolling out or getting more time to be right. So when you pay when you buy, call, or put and pray to be lucky. When you sell, call, or put, you collect and sit back until it goes against you to manage outcome. Yeah, this is for your initial trade. Yeah, that is why. I mean, I love to sell, call, or a put and get the probabilities on my side and not just start in a hole. You're right. If I buy a call or put, then then everything has to, all the stars have to align for us to make money. Market has to align, stock has to align, volatility has to align. If I sell, I already have a buffer or margin of error or a cushion with me. Okay, number two. So the previous one was you rolling out, means you move from one expiration month to another expiration month. So second technique is, let's say if a strangle in place, right? Let's create a strangle right here. Pick Apple, or let's say pick Tesla. So some favorite stocks, right? And let's go to this one. And let's say when Tesla hit 280 sometimes, right? Or let's assume that I created a trade when the Tesla was at, oh gosh, it's too bad. May or June side, right? Let's say 260 or something, 270. Assume that Tesla was at 270 and okay, I'll assume Tesla was 280 and I created a strangle trade 270 and 290. Again, and at that point of a time, maybe I collected premium of $9. I don't know if that's been true or not. We're just trying to mimic a strangle trade. I see a question. Do you increase the strike too or keep it the same? No, I keep the same. So generally, most of the time if I'm rolling it out, I'll keep the strike same. Keeping the strike same and make it easy to track your gain or loss, and if it drops, you fall behind. Yeah, that's very easy for me. If I were to increase a strike, then I would not consider it as a managing, but I will say, okay, I'm taking a loss on this and I'm going to put a fresh new trade. If I increase the strike, means that now I become more bullish on the stock, then my investment thesis has changed. I would in my mind and in the way I track, I will consider that as a fresh new trade. You could still consider both these trades as a two separate ones, saying I taken a loss in my July. I'm putting a fresh 290 short put trade or 195 short put trade in Apple. But if I'm keeping the same strike, then I consider that I'm managing my original trade. If I'm changing the strike, it's a completely new game, because that my investing thesis has changed now. All right, let's say I have a Tesla. I'd put on, okay, I have to make it a little where so that it starts to challenge us. So I need to put this to 80 and call will be, let's say 300. Yeah, let's say this was my original strangle, right? So what do if the strangle is being challenged? Again, the thesis in all the management techniques stays the same. Get more premium, reduce the risk. If the stock is trying to go against you, don't give in more money and hope that the stock will cooperate. Well, hope is not a strategy. I don't want to put in more money into the trade and then I hope that the stock will cooperate. I would want to reduce the risk. I would want the market to give me the money so that I've reduced the risk. Either the trade will turn out to be profitable. If not, okay, I got additional money, means I lost less. So that's the basic premise. Now, when you have a strangle, now this strangle is being, let's say, being challenged on my put side. Now, in what way can I get more premium, or can I get more money from the market if I were to manage this? Yeah. Of course, if you want to roll your side down, if you want to roll down your put, you will have to pay premium. So I'm not going to do that. So the right way is to, if you're challenged on a put side, forget about put. Roll down the call side of this house. So now if this is the case, means I would rather roll down the 300 call that I had to a lower strike price. Let's take an example. Say if I had a 300 call, rolling down means I buy this and I sell another one, let's say at a lower strike price. If I do that, I'm going to collect $4 extra. Again, the intent is still the same. So the base premise is still the same. Always try to collect more money from the market. So if I do this, I've collected $4 additional premium, which again pushes down my break even by $4. So my current break even is whatever we had, 12 cents, 280. It is 268. Oh, sorry, it's 280 and 12. That should be 268. Yeah, so this is my break even, which is 268. Now, if I do this second trade, which is managing trade, I get almost another $4. So my new break even would be out here, 264. So now I pushed my break even out on the side that is being challenged. Okay. Now, of course, the call side break even now will come in inside, but that's not where I'm having an issue. I'm having an issue on the put side. So if I have an issue on the put side, you want to get a little more margin on the put side. And the way you get a margin is to rolling down your call and by getting additional premium. Right? So if your put is being challenged, you roll down the call side. If your call is being challenged, do the other way. You roll up your put side. And in all of these cases, you will be able to do it for a net premium. You will collect additional premium. Right? So imagine And the reason is because when you put a trade, let's say, let me just start with this. Oops. Let's do a little more. So when I'm starting a trade here, I think maybe I'll have an example and in the next slide, and I'll take from here. Similar to what we had looked for Tesla. So let's say this XYZ stock is at 100 and I put a trade of 90 and 110 and collect $3 premium. So my break even is this. So this is your 90, this is your 110. Right now the stock goes down to 89. This is what we looked at. You rolled on your call, you get additional premium. On the other side, and in this case, when let's say stock goes down to 89, it's here, your 110 is already reduced in value, right? So you can buy it back, and in that case, you take a temporary profit on the call side and then put another one, which let's say you reduce it to 110 to bring it to 100. So your new trade will be now, this is 100. It will be this. This will gonna be your new position, but your break even will be further down. Right? So your new trade is still a strangle, but your new break even is here instead of here, and on the call side, your break even is here. But if it reverses, then you do the reverse of it, which is instead of a call, if it is, instead of a put, if it is a call that is being challenged, then we go the other way around, is to, let's start with the trade again. You got 100, you got 110, you got a 90. This was our original trade. Our break even here is 87 because $3 premium. Break even here is 113. Now, if the stock is actually over here, 100 and what did it say? 111. This would have declined in value already. So you could close it for maybe 10% of what you had sold it for, 15%, and then roll up this strike to 100. So your new trade becomes this, and you collect additional dollars. So your break even is getting extended over here. So give yourself more room on the side that is being challenged. Right. So that's how, whether it's on the put side or it is on the call side, the basic technique still stay the same, is how can I collect more premium? Once you've collected more premium, then it means either reduce your risk, or if the stock comes back onto your profitable zone, you could close it out as a winner. Right? Okay, I see a question. I have sold covered call on a growth stock, ran up, rolled the call once to manage the trade, collect more premium, still going up and hitting new 52-week high. How do you manage in this scenario, right? So when you let's go back to your thesis. When you put a covered call, what kind of a stock you want to put a covered call on? And I learned this, again, everyone pays a tuition to the market. I also paid my tuition to the market. And then I decided that if I want to hold, and the reason why we do covered calls is I'm still bullish on a stock, but I want to reduce my cost basis, right? I do it on the ETFs. I do it on the stocks like, Microsoft's, means heavy, big market cap stocks. And with I don't do it on a growth stocks anymore, but if I do it, I would do it if I have on a portion of my long holdings. because I went through this scenario wherein I did a covered call on all of my long holdings of a really, what do you call, the stock that became meme stock and a growth stock. And then like, oh gosh, I didn't capture all the upside, right? And I'll give you an example I had of a Stitch Fix. Very followed stock. I mean, it was a so-called a growth stock, new economy stock, everything was shut down. That stock grew up from $7-8 to went up to, I think, 60 plus. That's the Stitch Fix, not this one. Let's go at 3-year. Yeah, it was okay. Yeah, so we do have 2021, right? So I know, I think I had sold over here or somewhere. I had sold some covered call on Stitch Fix of some portion of my holdings. No, I sold a covered call on Stitch Fix, but it was not 100% of my holdings at 60. Right? Maybe I sold it when it was 40. I'm like, yeah, another 50% up, 60, that's fine. And then when it went up to 60, from 60 it went to 90, and I'm like, did I do a mistake? But good thing is I did not sell it on all of my Stitch Fix holdings, a portion of it. So I let the stock go and called away at 60. And then I put back, did a short put again on 60 after it got called away. Right? And then, of course, so in this scenario, first is when I put a covered call, I think, is it a stock that could go double? Is it a kind of more of a momentum stock, or is it more of a stable stock? If it is a momentum stock and I don't want to be missed out on all the upside gains, I would rather do a call spread and will not do just a covered call. I would do a covered call spread. Right? Maybe in this case, let's take example Stitch Fix. Maybe I would have done, let's say 60-80 covered call spread, because you might collect little less premium. Maybe you collected 15% less premium, but if these momentum, these meme stocks, these growthy stocks, if they suddenly go bonkers, you still have a chance to participate in the upside. That's one way. The other thing is, I won't even do it on 100% of my holdings. Maybe I hold, let's say, 200 shares of a stock. I'll do only one covered call. If I hold 500 shares, maybe I'll do only 2 covered calls. Right? So that's the other thing which I do, especially on these growthy stocks. Right? Now I have a covered call which is going in Apple. Apple was at $130. That time I did a covered call at 160. And then I roll it out, collected more premium, but Apple stock has been going higher and higher. But I'm not complaining, because overall, the portion of the overall Apple holdings have done wonderfully great, because I have more than 100 stocks in my portfolio, overall portfolio. Right? So I'm not complaining. It's a good problem to have. Right? So when you're looking at your portfolio, look at overall portfolio, not just options. It is better. Sometimes I feel it is better to lose money on option side in covered call, because then your stock side has gained a lot more. So that's what is happening with Apple with me this year. And damn, Apple has been going higher and higher, and without corresponding results in the revenue. Look at Apple, from 129 to 194. You don't see this very often, right? But sometimes that happens. So I'm happy. I think I still have a covered call in Apple. Then I moved my strike up to, I think, 170, but it's still at 194. I will still do it, because I want to have that negative delta trade, just to reduce a little bit risk. So I hope that helps. But this is how I would think if I'm trying to put a covered call. I have lost call trades by keeping the same strike when the stock jump fast like NVIDIA and can't catch up. So I sell a put to make up for the loss. So we'll come to that also. Yeah, there are ways, right? If your stock has got called away, right now, one of my Uber, I had a $42.50 strike price call. And yeah, and I think now it is probably in the money. It's a July expiration trade. I'm just waiting. It's now close to 42.91. If it gets called away, fine. It's not my 100% of Uber. I'm just gonna sell another short put against this. Right? So that's what I'll do. Okay, going back. So we looked at a strangle, but what if you don't have a two-sided trade? Like the previous one we looked at, where I had only a short put. Well, then you can make it two-sided trade. So that's another technique, is instead of rolling out, right, you could actually, you had a short put, then you can convert it into a strangle or call, or I would prefer call spread if you have a trade on some kind of a momentum stock, because going naked on a call side without understanding the stock could wreck your portfolio. So I would rather say do a call spread. Right? I do it, once you become more experienced and your rest of the portfolio is super, I would say, in a not stable, but has been de-risked, that time you can think of doing naked calls. Right? But if you're already using all of your buying power and now you're trying to add a call side, always do call spread. That don't, you get little less money, but then you're reducing the risk. And we never know what could happen in the market. I had a friend who would actually jokingly used to say that he lost a tractor by going naked on the call side on one of, I think it was an industrial company, which generally doesn't move much, right? Not industrial, I think it was a Budweiser, some beer company or something, which is not a tech company. But you never know what could be going in the boardrooms of the companies. There may be an acquisition that could happen. That acquisition could maybe at a double the price of where the stock is trading right now. And if you had a naked call on that individual stock, that becomes really, really very difficult. So when it comes to individual stock, my preference would be, let's do a call spread. Go wider on the call spread, but make sure your risk is contained. When it comes to the ETFs, I'm perfectly fine in doing naked calls because you don't have these acquisition price movements in ETFs. You don't have earnings movements in ETFs. You have these on the individual stocks. So if you have only short put, then do maybe add a call side to it. Or if you have a short call or call spread, then add a short put or put spread. So when you do this, you collect additional premium. And same thing is the net, the idea is how can I get more premium to either the reduce the loss or to convert the losing trade into a winning trade. Yeah. Statistically, and over the years, at least I've seen in my own trading, is it's generally a start with 70% probability, right? And if I don't manage the trade, it'll net around 70% trades which are profitable. But if I manage the trades, if I consider those as a single trade, the managed trades, combine the original and the managed trade as single trade, your profitability or the percentage of the trades that are profitable, you could increase it. I've seen up to 80%. You can actually get 10% upside by managing the trades. So that's why you do want to manage the trade. So now what's the criteria? Okay. So again, rolling up or rolling down if it is greater than 21 days, right? Then you roll up your short put if your call is being challenged, or you roll down your call if short put is being challenged. The stock has breached the short leg. Either it has breached your put side or the call side. If you have an iron fly, which is and if you've forgotten the iron fly, then that's this trade. Right? So iron fly, where you have sold a call spread and sold a put spread at the same strike price. In this case, if you want to manage it, you manage it if it has breached your break-even point, right? Because the moment you put a trade, it will move, stock will move, and your short strike, one of your short strike will be challenged immediately after you put a trade. So in this case, you manage it once it is breached your break-even, right? Ideally, you'll be maybe okay even if you don't want to manage it, because it's a defined risk and you were okay to take that risk, right? But when it comes to the iron flies, these are a lower probability trades, right? Because generally you can't get 70% probability between these two. Hence, I would want to manage it. But if it were an iron condor, which is like this, wherein if you're initially putting, you have a 70% chance that the stock will stay within this. And then if a stock moves out, I might just wait or take a loss. But this is a little lower probability trade, and hence I may want to manage it, even if it's a defined risk. Okay. Short call or short put, same thing. If you just have a short call or short put, if it is your breached your break-even point. 100% defined risk trade like iron condor, maybe I'll not do it. Okay. Net credit has to be greater than 0, so that again we add more cushion to our trade, right? The same thesis is more credit, more credit, more credit. I don't want to give money back to the market when I'm already in a hole. I want something to fill the hole. But things to be aware of: don't go overboard on rolling and change your thesis unless you want to. What do I mean by this? So, let's say, okay, let me delete all this. So this is, so your initial trade was, you did this trade and you were neutral about the stock movement. Stock is at 100, 110, 90, the same previous example. You were neutral about the stocks. This is, let's say, zero delta trade. So no stock, you don't have any directional sense on the stock. And you say, hey, I want to stay neutral. I don't want to add any bullish or bearish thesis on the stock. And you think this is 100 is adjacent enough, is price, which is neither too high nor too low, and stock should just move around 100. Okay? And you do this trade. Let's say the stock moves to 111, the example we looked at. You move this. Now you sold a short put at 100. Right? Now this is your whatever the break even is. Now it is not 100%. Right now this is not 100% neutral. Right? So what I'm saying, don't go overboard on rolling is, don't come all the way and roll it here immediately, because then if the stock comes back to 100, which is where your neutral position was, you're going to lose your money. Right? So don't go overboard. Give yourself time. That's why instead of, I would prefer maybe rolling it to 95, maybe rolling it to 100, if we still have, let's say, 30 days left. Because the probabilities may still work out. Stock could come back. Right? So you don't go too overboard and say, hey, I want to collect a lot of premium, and instead of rolling it to 100, let me roll it all the way to 110. And you doing it when there are 30 days left in the stock could come back, and then you basically get bitten on the other side. This is what's generally people are concerned on touching the unchallenged side, because they say, why because of the fear of getting whiplash on the other side. Okay. But if you don't go overboard on this, the chance of being whiplashed on the both sides is less. There are some stocks it could happen, but over a long period of time, those are maybe 1%, where the stock could have come back and now you are being challenged on the on the other side. But most of the time, majority of the stocks, at least I have not seen it. So you don't get this whip-sided on both sides. But if you go too overboard, then you increase your chances of being whip-sided. On individual stock, take it easy when you're selling a naked call option. I would say don't even sell a naked call option. Sell a call spread. So these are the how you will try to manage your stocks or your option trade, not the stock, but option trades that have gone against you. Basic thesis is get more premium, fill up the hole, let market give you money to fill up the hole, and don't go overboard in trying to collect too much of a premium while you still have many days left in the stock. Right? At the end of the day, this is a probability game, and the probability is true for the expiration. Right? When we say that I've done a 70% probability trade on this particular stock, that probability is till expiration, not today. And I still have, let's say if I did 4th August, I still have almost 30 days. Then I just want to wait before I become too aggressive in trying to adjust a stock, because, hey, the probabilities could still play out. So then I don't want to go all the way to 110, that if actually probabilities play out, I ended up on the losing side. Maybe I'll just do 95, maybe I'll just do 100. So over a period of time, you learn when you have to start managing the trade, right? If, like I said, ASML trade is being challenged, come on, guys, I have 41 days. I don't have to panic. I'll sit tight over there. But if it is, we are in August, and then and then my trade is being challenged, then I'll say, okay, guys, now I need to manage it. Because then not too much time is left in the trade for management, and then that's the time when I'll start to manage it. So yes, that's all on the management side of managing options. There is one more criteria of which I have not touched it, which is when you actually go inverted. But that's a little more advanced. You kind of end up locking the loss, not the loss, but if a stock comes back, you will end up reducing your profit, right? But we'll take that up in some separate sessions. But that's the final stage when you start to go inverted in a triangle. Cool. That's all on the management. Let me hear your feedback. What else do you do to manage a trade that has gone against you? For me, these are the tricks. Either you get more time. If it is already less than 21 days, I would move it out, give myself more time, or I will do if a call is being challenged, do a put trade, continues to stay challenged, roll up the put. If the call is being challenged, so if the put is being challenged, add a call trade, call spread, if continues to challenge, roll it down. That's all it is. It's not too complicated. The only one, hey, how can I get more premium? Freddie asks, when you sell covered calls, at what delta do you pick? Let's say Google is at 120. So when Google was at 100 and no, it wasn't 120. Let me see. Google, I have a covered call at 140. So I picked up, again, there is no correct answer to it, but I will give you my thinking process, and then you can see how you want to apply that thinking process to yourself. Okay. Say I have a X share, stock XYZ. No, let's take Google example. So Google is at 120. Wonderful. So I have a Google. So if I were, so here, this is the thinking process which I'll go through. If I'm only owning 100 shares of Google, and I'm super bullish about Google because, hey, Google hasn't participated in the run-up like other companies have, right? Like NVIDIA has, and I'm like Meta has, and I'm super bullish about Google. Then, and I only have 100 shares of Google, then in that case, I'll probably go and do uh, 100. This is, oh, I don't have it. Okay, I have a deltas here. So I'll probably do 130, which is around deltas, and 100, and I'll do a call spread here because I only have 100 shares of Google. And I think Google has could have a lot more run up, right? If I had 200 shares, 300 shares of Google, then I don't mind. If I have 200 shares, then I don't mind doing just 135 or 131 covered call. And let's say if it is, instead of Google, if I have NVIDIA, and I'm thinking NVIDIA has already run up so much. So for now, and if I have 100 shares of NVIDIA, and I have bought those NVIDIA shares at $200, I'll be okay to do it at 30, 35 delta, 40 delta, because NVIDIA is already up 200%. So it's not just one factor that comes into it. There's a lot more thinking process that goes in before I'll pick a strike price. So when you ask me what delta, I can't give you correct answer of what delta, but this is the thought process I'll go through it. If I have only 100 Google shares, maybe I'll go 16 delta only, because I want to give myself a lot more room if Google continues to go higher. If I have 200 shares, maybe then I'll just do one at 20 delta, or maybe I'll do a 30 and 10 call spread. So that's how I decide and make a decision. Hey, what else? The other thing is, you have to think about yourself. If, let's say you sell we picked up Google, right? So I have a Google covered call at 140. Let me see, when did I add that covered call? Okay, I'll bring up that trade. Hold on. Then, because then I can tell you when did I do that. Oh, come on, this is my tracker. Google. Okay, just give me a second. One sec. GOOGL. All right, so okay, so I did this in Google. Oh, I have 130, not 140, it's 130. And I did this on this day. So I have my note on 6/29. I sold a covered call near 23 delta. Stock was, at that point of time, the stock was trading at 118. Right. So this was the stock trading price was. And the delta was, that time I did it on 6/29, delta was 23 delta. Now, the reason I didn't do a call spread here is I own more than 100 shares of Google. So if one of the tranche of, if one covered call goes in the money and 100 shares are called away, I'm perfectly fine with this. Because remember, we looked at a coffee can portfolio. So I go and look at it, how much of that is in a coffee can and how much is outside the coffee can. Then I said, okay, I have a 100 shares, which I kept outside the coffee can. So I can do one naked covered call. And I went ahead and did that on 29th of June. I don't know where Google was. Yeah, Google was $118. So it hasn't moved much. And I think this trade is probably 130. Yeah, hasn't declined. It hasn't decayed also much. So I'll wait for this to decay. If it gets called away at 100, that's fine. My coffee can portfolio holding Google will grow higher. So that's how I make a decision. What else? Yeah, I can hang around for 15 minutes. I know we are over our 2-hour mark, but okay. So let me give you some more narrative around covered calls or covered call spread. Hold on. Now let me go back to my trades and see. Okay, let me pick up some of the latest ones and share it with you guys. Okay, here we go. Okay, already. Let me just copy it, and then we can have some discussion on. And again, this is way more, but that's why I journal it. I journal my trades so that I can go back and see what I did, why I did. Okay, XPEV 6/16th. I opened a covered call. I didn't capture the delta. Stock was at $11.41. I sold a call at 14. GLD 620 and then 23. I closed it. 620 covered call near 25 delta. GLD was 179, 185 call, 25 delta. Roblox 25 delta. Shopify, I have one covered call near 25 delta. The Roblox, and I closed it. So looks like I opened another Roblox. After I closed one at profit, I opened another Roblox at a 50 near 20 delta. Cost basis is 47. So I'm like, yeah, 50, I can open. It is 20 delta. I think these are the more recent ones, right? I've not gone back more in history. The one which are grays are already closed. These are still open. I have one on Ford at 15 for August expiry. Stock was close to 14. K-Web looks like I closed it recently. I forgot to put the note here, but this has been closed. It was at 20 delta. ARKK and 30 delta, because I hold more than 100 ARKK in my portfolio. Don't mind opening 30 delta, even though ARKK could become a little mimi, but that's fine. TSM near 15 delta. This is just to reduce the cost basis. Chumia is, I think it's near 30, 40 delta, but that's fine. NVIDIA, I have a covered call spread. BlackBerry, that would have been 15, 16 delta. Google near 23 delta, the trade I showed just now. Coupang, I have on a portion of long holdings, I have a covered call. Unity near 20 delta. XLF is near ATM. I hold more than 100 XLF. It's an ETF. BlackBerry, another near ATM, is covered call, which I opened on 6th. Shopify for August had closed July for profit, so opened one on August trade. I think these were the last recent covered call trades. So hopefully you get my thinking process around, depending on how much I hold, and then what do, based on what my thesis is, and then I pick up the deltas accordingly. So journaling helps us, or at least helped me to stay honest and what I did, why I did, because you can get carried away by your emotions. So having this journal, I know, okay, if I did this trade, when I did it, what I did it, what was the stock at, where was the stock at that point of a time, and then what I did with that trade. Cool. Alrighty. Any last minute questions before we call it done for today? Useful? Any feedback? What else you would want to cover? Chat GPT. I don't know what to talk about in Chat GPT. So, I mean, you want to look at Chat GPT for what? For task scripts? Because we kind of talked about Chat GPT earlier. Maybe I think I read somewhere around the 10 non-public AI companies that we should look for. So maybe I'll go through the list of those, but those are non-public, so nothing you can do unless you are a private company investor. But maybe I'll go through that. Can you use it for watch list or holding? So one thing which I found on ChatGPT, when it tries to give me the numbers, those are not always correct numbers. So I always had to go and validate it. For example, I asked ChatGPT to give me the, what was it? Free cash flow, revenue growth, free cash flow growth, and return on equity for Google and for ASML for last 20 years. Some of the numbers were incorrect. So I was like, oh, I can't use it for numbers yet. I don't know where it picks numbers from. But I don't use ChatGPT for my day-to-day, let's say, for investing, etc. I use it maybe to write some think or swim quotes, think or swim script, or I tried to use it to get some data that I was looking for that company. But when it started to give me wrong data, then I said, maybe I'll not use it. Cool. All righty, guys. I think that's it for today then. Looks like no further questions. Thank you, everyone, for your time. If you have any specific topic that you are more interested in, just send me a message on the meetup. And I'll see if I can cover that in our next session. Otherwise, I'll bring up whatever comes in my mind, I guess. And again, I'm not full-time on this one, so I'll spend some time to pick up some content. Cool. Thanks, everyone. And we'll talk again next week. Goodbye.